Hey Pat, great to see you. Just a reminder, I am Marcus Schaefer, the Director of Growth here at Greenspring. This is Pat Collins, our CEO. And Pat, I'm here with one question for you today to kick us off. What the F is financial planning?
I thought this was a PG podcast, but we'll dive into it. Great question, and it's one I think that a lot of clients and investors have when they're thinking about what is it that you guys do? What is financial planning? So I have a few thoughts. Maybe we can kind of kick that off with that. First is I think there are do you consider financial planning a noun or a verb? And we think about it as a verb, but I think a lot of people in the industry think about it as a noun. So just to expand on that a little bit more, a lot of times a lot of times people think about a financial plan as this document that's created or a binder or whatnot that has all of their information in it and all these projections, and it's this thing that you do as far as like you put this together and it's a document that you have. It clearly is a part of it, but really we believe more in financial planning or the actual act of what you're doing each year. Because the thing is that your life is not a point in time. The economy is not a point in time. Taxes are not a point in time. They are this dynamic changing thing, and all these things change all the time. And when you're doing financial planning as a verb, it's an act of doing something. You're always changing. You're always having to tweak. You're always having to make updates to it. And so we think that it needs to be a dynamic process. It needs to change with your life. Your circumstances could change, but your plans could change too, what your goals are. So I think that's a really important concept when you're thinking about financial planning. A few other things that I would just say about financial planning, and this is probably has some similarities with investing. We are dealing essentially with uncertainty when we do financial planning. We do not know what the future is. And when you're doing financial planning looking forward, you are making assumptions on what's going to happen in the future. And that is a really difficult thing to do. We can make really good guesses, but that's really what they are. And so that's also a really important reason why you don't want to do a financial plan as a one-time thing, check the box and say, I've done my part here. I'm moving on to whatever it is else I'm going to do in my life today. It really should be a dynamic, ongoing thing because your circumstances are going to change. There's uncertainty in your life. There's uncertainty in the economy. You need to kind of stick with it. You should be updating it regularly.
Yeah, I mean, you kind of talk about financial planning done poorly versus done well. I think about this. I've worked with some of the best advisors, and everybody talks about financial planning, and it's kind of a different output for everybody. And you told this story one time about somebody that you have a 300-page financial plan, and like 3 pages are actually useful, and the rest is just kind of these back-end assumptions. So let's maybe spend a little bit of time talking about what is kind of diving deeper. What is financial planning done well versus poorly? And then we can talk about kind of 2 different situations. What are some of the components of financial planning in the accumulation phase? And then we could jump into kind of the withdrawal phase because it's really a life cycle, right? So we don't want to bucket into 2 components, but it's just easier to think that way. So we'll do so for the purposes. So let's talk a little bit more about what financial planning done well is compared to done poorly.
It's a really good question. The financial planning done well, in my opinion, at least I think the feedback that we've gotten from our clients over time when it's done well, that you'll hear things like, I just feel so much more at ease. I know that I'm on the right path. I know that when things change, I can talk to you guys and we'll make updates and changes and you'll tell me how I need to tweak the plan. So it's this decision-making framework in a lot of ways. And, that's really what financial planning is this trade-offs that you're thinking about. I mean, to give you an example, like if I wanted to buy a second home, I might have the money to do that right now, but I should understand in the context of how is this going to impact other things, because now I'm going to start using resources to buy, pay for a new mortgage or whatnot. That's going to divert away from maybe my retirement or my kids' college or a legacy that I want to leave. So no matter how much wealth that you have, there's always going to be trade-offs as far as, your financial plan. And so a good financial planning helps clients make good decisions, in my opinion. So you have all the information and you can make a really, really good decision. What it looks like. Sorry, go ahead.
And you're kind of building off on this point about trade-offs. And I think there's this really important concept in economics called the second best choice. And what it means is kind of you have a first best, an optimal decision, right? But then you have this second best choice. It's not a bad choice, it's just a different choice. And this is maybe one of the differences between a point in time financial plan for something, which is, hey, let's think about the trade-offs associated with these decisions and then make the best one for you, not the best one for some metric that you don't really care about that relates to the financial plan, right? And in that case, the second house, hey, this might give you so much more happiness and fulfillment. You're willing to draw resources down. But from an optimal financial plan, like, does this help your plan? It probably does not.
It's a really good observation. One of the things that I think sometimes, maybe this is where it's done poorly, and I have some other thoughts on how it's done poorly, but when it's only thought about as wealth accumulation, of how, the plan outcomes should all be about how much more money do you have. That's not typically, when you start to talk to people, what their ultimate goal is. I want to die with a lot of money. It's usually to accomplish things. It's to experience life. It's to create, maybe experiences with their family or whatnot. And so really making sure that your financial plan isn't set up for just maximum wealth accumulation, but it's really more about like maximum enjoyment of your life. And so that means that you have to consume some of your resources. But again, there's trade-offs there, and you just have to be aware of those trade-offs that you're making. And so for some people, the right decision is, I'm going to consume a little bit more now. And I understand the trade-off is maybe I have to work a little bit longer, or maybe I'm going to have to spend a little bit less later. But that's okay, because that's really a good trade-off that I want to make right now for whatever circumstances there are in their life. So for us, I think being very one-sided to think financial planning should be all about wealth maximization is not really a great way to kind of consider things. Really at its worst, in my opinion, from a financial planning standpoint, and you see this as well, is it's used as a product sales technique. So it's, hey, we did this financial plan for you. It's 300 pages, like you mentioned. It's in this nice leather-bound book. And oh, by the way, you need to buy a lot of life insurance. Now, you might need to, but if it's being used as a sales tool, to me, that's probably where it's done poorly. Or if it's used to try to sell different funds or mutual funds or whatnot, this is really not meant to. Financial planning should not be. It will involve products potentially at some point because you have to implement. But if it's being primarily used as a way to sell those products, that to me is kind of what, financial planning done bad looks like.
Yeah, it's the difference between, if I think about it from a consumer's perspective, what is the product I'm getting? For us, we want to be providing advice. That's the product. Once you start getting into, hey, no, it's actually a thing that you buy and it's cookie cutter and it works with most people in your situation, that's when it starts to get, that's when you could tell maybe it's more of a sales tool versus an advice tool to talk about frameworks and decisions to help you live your best life. And then that kind of gets into, I think, you could tell I've spent one too many times in a business school class, because the way I think about financial planning is every great company, they have an income statement, they have a balance sheet, statement of cash flows, and they use these documents to help them understand this year, next year, 10 years down the line, what is my expectation around cash flows? And then what can I do with that, with those cash flows? And I think some of it, you hit at one of the ways it breaks down, but let's talk about the similarities and then some of the differences, kind of viewing it through that lens. A financial plan for a company, how is it similar to a financial plan for a person?
Yeah, there's quite a few similarities, and there's definitely some differences as well. But I think the similarities are that we have very similar financial statements for a household as we do for a business. So in a business, you have a balance sheet and you have a P&L or profit and loss that shows income and expenses. And you can do the same thing for a family. You have a net worth statement that's going to show assets and liabilities. And then you have an income statement that's going to show income that's come in as well as expenses for the family. with those two statements, if you can put those together, you can do a lot of work for a family. And as an investor, you have a lot of insight into how things are going. If you can really look at those statements at a singular point in time, but then historically as well, to look to see how things are going. And to your point, if you want to take it a step further, you can project things out from those as well. So there's a lot of similarities. I would say for Greenspring, that's where we start with every client. There's two things that we're doing at the onset. So one is, when you talk about this, is really trying to vision cast for the future for a family of what is really important to them. Probably similar to a company doing strategic planning. Where do we want to be in 10 years? What markets do we want to be into? What are the products that we're going to sell? Things like that. A family is going to be, there's differences, but there's some similarities there. We're going to say, where do we want to be in 10 years, in 20 years? What are the big things that we want to accomplish? And so that kind of gives us the one side of the equation. And then the other, which is where do you want to get to? The other side is, where are you starting from? And that's all of these financial statements that we're talking about. And really good financial statements are going to have assets, liabilities, income, expenses. And that kind of gives us the bookends. If you think about it, it's where do you want to get to? Where are you starting from? And then our job as planners is really figuring out a way to get someone from point A to point B. And I would say that the other part to that is in the most efficient way possible. There's a lot of different ways you can get from A to B. Some of them aren't efficient. You can burn your money on certain things. You can pay too much in taxes. You can have really high costs on your investment products. You can not have the right setup with different accounts. So we're trying to optimize that so clients can get there in the most efficient way, hopefully the quickest way possible too, to get to their goals.
Yeah, and I think another similarity is there could be kind of different versions of complexity. Probably everybody needs a financial plan, but the complexity of the plan should reflect the complexity of your situation. So if I'm 22 and I have no debt, my financial plan is like pretty simple. Be great at my job, save as much money, invest cheaply. Like, you don't need a big balance sheet analysis to understand that there's nothing on the balance sheet. And then you get into these more complex situations, and this is where your assumptions can vary a lot, and they can vary a year as well. But again, I think something else that's really similar is what I just referenced, assumptions. And you talked about that earlier. Everything we're doing is so critical on assumptions. A lot of those assumptions are very volatile year to year. Talk a little bit about maybe how you see assumptions playing a role in a financial plan.
So it's critical. Financial plans, especially for people that are younger, are so sensitive to the assumptions that you put into forward-looking projections. Probably the same as a company too. You say that they're going to grow at 10% versus 12%, there's vast differences in the future values of that company. So from the standpoint of assumptions for a household, there are some that I would say we have control over to a degree. And then there's some that are out of our control. So some of the things that we need to make assumptions on are things like, what is your income going to do over the next 10 years? We need to make assumptions on also, how much of that are you going to save each year? What are you going to be doing from a spending perspective over the next 10, 20, 30 years? Are you staying in your current home? Are you going to buy a second home? Are you going to give money away? Do you want to start some other venture in a business that's going to cost some money? So there's so many assumptions that go into, the personal household situation. And then on top of that, you're going to have assumptions on what's happening externally. So what's the inflation rate going to be? What are taxes going to be? What are the investment markets going to do and the capital markets over the next 10, 20, 30 years? So all of these have uncertainty associated with them. Some of them are somewhat correlated. The inflation rate and investment markets might have some correlation together, but probably not a ton on maybe where you're working 5 years from now is going to be based on so there's a lot of things that are totally independent of each other that are happening. And that's why, again, it's so important, we think, to be revisiting that, at least once a year, maybe once every other year, and maybe even more frequent if your circumstances are really changing. Because some of those assumptions we know for a fact, maybe the majority or all of them are going to be wrong. We just don't know with 100% certainty what the investment returns are going to be. We don't know what your income's going to do. So, that's why when we're doing a financial plan, we'll start at one point and we build these projections. But what we need to do is come back to that and revisit and say, are we on pace for what we thought we were going to do, or are we behind, or maybe we're ahead? And if we're ahead for reasons that are not really, for example, let's say we start with a client, we think that the investment markets and their portfolio, however their mix is going to go, we're assuming a 6% return, let's just say. And let's say we had a year like last year and their portfolio is up 15%. Should we make changes to say, oh my gosh, now you can spend more? Now you can retire earlier now after when? No, probably not. We're going to say this is just normal variations in the investment market. Conversely, if we're making an assumption on somebody's savings rate, and we say, we think you're going to save $100,000 a year, and for 5 years straight, they are saving $50,000 a year. Moving forward, we probably don't want to use that $100,000 savings figure. We probably want to get it back towards more reality of what it's been. And by that, then yes, we probably need to start talking about adjustments to the plan. Hey, we thought you were going to spend 100 or save 100. You're only saving 50. We need to think about extending out your working years, maybe spending a little bit less, maybe, that second home, maybe not spending as much on that. So anyways, it's the assumptions are so critical. You don't know what they're going to be. So that's why they're assumptions. And that's why you need to keep coming back.
Yeah. And you just touched on it at the very end of that, which is realistic assumptions. And this is why you need somebody you trust, because anybody could tell you, hey, we think stock markets are going to do 15% because they did that in the US over the past decade. And we're going to extrapolate that forward. And the tough conversations are the ones around that US recent return. That's actually a significant outlier compared to what we've seen with returns across countries, across the world. And hey, if the US keeps doing 15%, we're going to be in a great spot. The likelihood, based upon all the evidence we have, is that was just a period of relative outperformance. And we should be very thankful for it. But that might not be something we want to factor in. And sometimes what we see is if you come in and your expectations are vastly different from what is realistic, it's going to make your financial plan look great. But in 10 years, you're going to have a lot of really tough challenges because you might have spent too much relative to what's realistic. So I just think, just like as a company goes to somebody else to get their valuation done, whether it's a third party valuation firm or an investor, you kind of have to go to a third party to say, hey, are these assumptions we're using realistic? Because we're making spending choices today based off of them.
It's a really good observation. I think it's one of the kind of dirty secrets in the industry that I believe needs to kind of be revisited. So it's similar to a company. If I'm looking at, let's say I have a client who is considering investing in a private equity firm, and he sends me all of their, investor materials, and it's got projections for the future. They always look good. They always look good. And so a lot of times what I see with financial plans is the planner is not doing enough digging in the backwards side of things, looking backwards to say, did they actually accomplish these things, these savings rates, these income figures, whatever it is? Because if all you're doing every year is coming back to the financial plan and just updating the asset values, that's not enough, because you really need to understand if you've been using a certain savings rate and that client hasn't been hitting that bogey, then you really need to be thinking about, do I need to adjust the forward-looking projections? They're too rosy, basically. So yeah. I think there's an element when you are doing financial planning of looking forward, making these assumptions that we think are best guess. But to inform those guesses, you have to look backwards, not only at the investment markets and taxes and things like that. That's what a lot of people, are. You also have to look at the household situation and say, is this realistic based on the past that they would continue to do this in the future?
Yeah, that's it's great insight into how you can really think about realistic versus unrealistic. Let's maybe jump into some of the key differences, I think, between a household's financial analysis and a company financial analysis. Kind of referenced one of them a little bit earlier. I'll just call it out, which is companies have a very specific purpose: maximize profits. People have a very specific purpose: maximize what the economists call utility. This is why they're not fun to hang around. What they really mean is happiness, right? Our goal is to maximize happiness. And Hey, if you have more money, you probably can have more happiness because you could do more things with that money. But I think that's one of the key differences between a company and a person is you're actually trying to maximize two different things, and oftentimes they get confused.
And they're kind of at odds with each other. If I told you we're going to save every single dollar that you make to maximize your wealth, that's going to probably drive down the level of happiness you have. Well, you can't go on vacations anymore. You can't be a member at this club. You can't do that or this. You can't really spend money on yourself. So yeah, there's definitely a give and take there. So I totally agree with you that's a huge differentiator between a company and a household or individual. I think the other part is the time frame. We all, we're here for a short period of time, all of us, but companies can be around for generations, and hopefully they are around for generations. So there's kind of a perpetual life versus a finite type of planning period that you have for a client. Even if it's intergenerational and you're planning for the next generation or third generation, there's still some level of kind of time that you're factoring in. Whereas a company, they're trying to basically perpetuate forever if they can. That's probably for most companies, unless they're trying to sell, that is a goal that they want to continue to maximize profit for as long as possible.
Yes, and some companies, their goal is, hey, I want to sell in 3 years, so let's maximize everything until then. I have yet to find somebody that said, hey, I really want to be happy for the next 3 years of my life, and then I'm good being disappointed beyond that point. The last one is a very nuanced one, but I think that it's really helpful to think about. For individuals, a lot of income or revenue is actually taxed before it reaches you. And that's just something that kind of plays into some of the dynamics of things you could do down the income statement, where if the government's taxing you right up here, not on your profits, right? So you can net out expenses in all cases, but right there at the revenue mark, that's going to have some different effects for abilities and ways you can structure things in order to maximize total lifetime happiness by keeping more wealth in an after-tax like spendable reference. And this is where another dirty secret of the industry is everybody's talking about pre-tax numbers. And sometimes they're talking about pre-fee numbers too, which is a really weird thing. But it's not, hey, if I want to go spend my money, how much money do I have? How did I grow that money? It's, well, here's how we grew your money before all these different considerations. So I think that plays a role too.
It's great insight into, there are a lot of similarities, but there are also a lot of differences. The last thing I mentioned that we haven't really touched on, but I think it's interesting from a role standpoint is, at a corporate, at a company, you have a CEO and a CFO typically at a larger company. So when you think about what each person's role is, the CEO typically casts the vision for the firm. Where is it that we want to go? Making kind of strategic big decisions. The CFO's job is really to think about how are we going to get there financially? How are we going to handle financing? And how are we going to do, debt issuance or things like that? And how are we going to set up the projections and make sure that we can accomplish all these things and coordinate it with all the different departments? So how that would relate to a household is, we kind of say this often, we consider ourselves a company's personal CFO. So, but the client, the household, they're the CEO. They're the ones that need to set the vision. And we can help them with this, but set the vision for the future. What is it that's important to you? What do you value? What is it that you want to accomplish in your lifetime? And then our job as a CFO is we got to figure out all the money parts of it to get them there. And so, we're going to probably touch on a lot of those different areas, but anything financial kind of runs through the CFO at a company and probably runs through a really good planner through a financial plan.
Yeah, and what you're talking about is the difference between kind of strategy and tactics, right? And strategy, that's your long-term vision that we've been talking about. But tactics, these are the things you have to do every day, every year to make that strategy realistic. So let's maybe just jump into some of these different tactics in the accumulation phase. So this is a phase where you have more human capital than financial capital, right? Which you're younger in your career. If you were to do a present value of all your future cash flows, you'd say, wow, I have so much present value from my ability to earn money. And what I want to do is I want to turn that salary, that paycheck, the dividends from the company I'm running into financial capital. So when I stop working, I have something to pay me back. So let's talk about this accumulation phase and what are some of the tactics for how we think about the income statement and the balance sheet.
So like I'm gonna talk, I think it's probably good to talk about it in the context of these financial statements. So we have income statement, balance, and net worth statement. So it really all starts with the income statement, in my opinion. So you need to get that part right, especially when you're younger. There's not a whole lot on the net worth statement. You don't have a lot of assets, probably therefore you don't have a ton of debt. But if you think about the income statement, you have income and expenses. A lot of times people might just stop there and just put them on a piece of paper. We like to think through each one of these categories. So maybe on the income side, I'll start there. Probably one of the best investments you can make if you are a young person that's in the accumulation phase is figuring out ways that you can increase your income. You made a great comment that your largest asset, if you're going to take the present value of all of your income over the next 40 years, that is by far your largest asset. So if you want to talk about sensitivity and assumptions, well, if you figure out a way to make 10% more because maybe you got a designation or a certification, or you move into a different industry, or maybe you take a drastic change and you decide you have this lucrative business opportunity, you could start a business and you could make more money. All those different things are probably one of the largest determinants when you're young on the success of a financial plan or your overall situation. So us helping to think about with our clients, how do we increase your income is an important step. Some of that is on the client. But I would say there's a lot of examples of us getting involved in that with our clients from the standpoint of things like making connections. If we know client A sells some products that client B could use, we're oftentimes trying to connect them. A lot of our clients, unfortunately, lose their jobs. We are trying to connect them with companies that we know could. This is kind of an ancillary thing, but because Greenspring's got a decent network, we are trying to figure out ways to help enhance income. So that's probably on the front end from an income statement standpoint. The other side of that is the expense side. And this is really important to get right, because if you can get these two things right, you're going to have margin. You're going to have extra savings at the end of the day that now flows into your assets on your balance sheet, on your net worth statements. When you think about expenses in the accumulation phase, there's really 5 places it can go. So it can go to taxes, it can go to giving, it can go to debt reduction, it can go to general spending, and it can go to savings. And one of the things that we're doing when clients come to us is we're looking at the ratios there to say what percentage of your income is going into each of those 5 buckets. And when we see an imbalance, their debt is really high, and therefore that's starting to crowd out other things like maybe spending. Maybe they just can't really live that well because they got to spend so much on their mortgage, for example, or their car payments. Or more likely, what first gets crowded out is savings. So we want to get those ratios right. We believe there's certain ratios that you need to keep. And that's something that we're looking at on the accumulation side are things right on the income statement so that you're putting yourself in a position where you can save enough to be able to kind of transform that human capital that you have into financial capital.
Yeah, nobody tells you when you start out in your career that, hey, if you get one of these high-paying jobs, your chance of getting let go actually increases a lot, right? It's like, hey, no, I make more money, I'm more stable. Well, there's a lot more challenges that come with that. So I think that's an interesting point. And then on the expense side, to your point, going back to the CFO, CEO role, our role is not to tell you what you can and cannot do, but a lot of times when you go through those buckets, you find expenses that you look at and you say, hey, this is not worthwhile for my happiness that I get out of this. You find I have 2 houses and my cable bill is $5,000 a year. So how do I think about, is there any other option besides cable? And lo and behold, we live in a super innovative economy. You could get YouTube TV for $100 a month at both locations, right? So there's this ability sometimes to stop and reflect and say, going through this with somebody else, what do I get enjoyment out of? And it's not really a budgeting exercise. Budgeting exercises for millionaires vastly different than everyone else, but it's more of a happiness exercise. And a lot of times we find that people are actually underutilizing capital today, right? So it's, hey, actually, maybe you should go out one more time or two more times a month to a restaurant and enjoy it, because we're looking at your financial plan, we're confident in the assumptions, and you're going to have enough down the road to start to utilize some of this when you can.
At the extremes, you see bad things happening. So on one extreme, you have the person who is overspending that can't save any money. That's obviously not good. That's what, you see, we have a savings problem in the US, and that's a bad thing. We tend to see kind of the opposite a lot of times at Greenspring, which is the chronic underspenders, I guess I would say, or savers. And you'll see that sometimes happen, and that also at the extreme is bad, because there's just kind of this feeling that you never have enough. You can never be secure and safe, no matter what we tell them, no matter how many projections we show. I remember I had a great client who passed away just a couple years ago, and she lived during the Depression, and she was young, but she had this memory of losing her house as a child and essentially being homeless. And she never made more than $40,000 a year in her career, between her and her husband. They retired with, tens of millions of dollars. And, it was really interesting, because they got to the spot. And as much as I tried to encourage them, you need to spend more money, you need to go out and travel and enjoy things, they just had a really hard time. I went to their house. Their stove had to be from the 1960s. They would not update things. And so a lot of these things that happen from a spending standpoint, that are behavioral, it goes deeper than just, I wasn't sure how much I should save or spend. There's a lot of times deeper issues that go back to your childhood and whatnot. I don't want to get all philosophical here, but I do think that it helps to understand why you're doing what you're doing. Are you trying to get fulfillment by spending and buying new stuff? That typically doesn't work. And do you feel like money, to the extent that you have millions and millions more than you need, is going to make you feel secure? That probably doesn't work either to some level. So really understanding yourself through this is an important aspect of it.
Yeah. Wow. What a crazy story it is. You reinforce a behavior over your life, and then trying to reverse that, in both directions, is a really, really hard thing to do, which probably makes, more power to figuring out the right balance as young as you could be, and then making little adjustments along the way. Let's maybe talk about some of these other examples. I think, oftentimes people in the accumulation phase, it's like, what are the biggest assets that they have? Number one, future earnings. Number two is oftentimes somebody's primary residence, right, early on. And you could get that because we have great legislation and regulation in America that really encourages home ownership and makes it really favorable, and some advantages to it. So how do you help somebody think about their home purchase and making sure that that fits into their financial plan in the best way?
Yeah, so you touched on this before. I'll just mention it, and then I'll touch on the home purchases. So I think it's really important to understand the difference between strategic and tactical with a financial plan. So I think of strategic as like the long-term things that aren't really going to change that much. If you do these well, you've got like 90% of things in really good shape. Your plan's going to be in good shape. So that's things like how much you're saving each year. That's a huge component of your financial plan. It could also be what asset allocation you choose. What's your risk, that you're taking in your portfolio? Those types of things are going to have massive impacts on the overall success of how much wealth you accumulate and what you can do in the future. But then there's these tactical things that happen every single year. And I look at these as kind of more like the pennies and the nickels, or another analogy, the singles and the doubles that we can do that will enhance and optimize overall wealth accumulation over time. So buying a house would be one of those things where there's a strategic element to it, which is what size house should you buy? First off, that's probably a strategy decision, because if we buy something too big, it could really derail our overall kind of resources that we have for other things. But let's say we make that decision right now. It's, well, how do you optimize buying this thing? Because should I put money down? Should I finance it? What are some other aspects? So I'll give a couple like quick, anecdotes, and usually it involves financing when you buy a house. Most people aren't just writing a check for whatever the value of their house is, especially their first home. But we had a great example just recently from one of our advisors whose client came to them and said, I need to put a down payment on this house. And it was a sizable amount of money. And so they said, I need to liquidate some part of my portfolio. And, at the easiest thing would have been to say, okay, well, let's just pro rata sell whatever it was, a few $100,000 out of the portfolio and send that to the client to be able to buy this house. The advisor took a little bit different approach and said, I'm going to go through every position that they have. And not only that, I'm going to go through every lot that they own. So a lot would be, if I own 100 shares of Apple, maybe I bought 3 different lots, 2 lots for 30 shares and 1 lot for 40 shares. So he went through every lot and looked to see where are the lots that they have losses on. And I'm only going to sell those, so that in the first example of just selling everything kind of randomly, it would generate a large tax bill for the client. And in the second alternative where you're picking lots, in this case, they actually had no tax associated with raising these funds. So that's a tactical thing that can happen on a kind of a year-to-year basis. The other thing would be things like, we'll have clients trading homes, if that makes sense, where they're in a home and they say, our family's got bigger, we're buying another home, but we need the equity in our current house to buy the next house. Well, there could be a timing issue sometimes with that. Maybe they want to buy that next home, but they're still going to own this first home, for some period of time before it sells. So that's a tactical decision of like, how do we do that optimally? Do we want to get, maybe in the second home, we don't want to take out a big mortgage because we're going to be able to have all this money to put down, but we don't have the money yet. So how do we deal with that? Do we want to pay all these fees for a new mortgage when we only need it for like 90 days? So there's a lot of times we'll be looking at things like, well, what are other lending alternatives that we can do? And let's measure the interest costs and the time and whatnot and figure out what's the most optimal way to do this. So again, the strategic that's the most important things. But then there's these other things that are like, hey, if you do it this way, it's going to save you $2,500, or we just avoided $4,000 of capital gains taxes, or whatever the number is. And that kind of stuff adds up over time if you have a good planner that's thinking through the tax.
Yeah. And if you tell me as a client, I just want to tell you, hey, we want to sell our house, buy a new house, and I just went through signing all these paperwork. If I could avoid the mortgage process, I would really appreciate that, because there's a lot of signatures that are required. And I also think something else in that example too is one of these abilities to unlock. And that's just thinking about the interlay between your investment accounts and what you need to fund those investment accounts for, right? And I think there's this big common perception where it's in a really safe environment, you save as much for your down payment as possible, right? And one of the differences, your example, somebody's pulling from their investment account. So it's kind of one of these things where if you're able to save more, you can actually take a little bit higher degrees of risk versus somebody saying, hey, I have to save $200,000 in a bank account that's going to lose money after inflation every single year, maybe keep up with it. There's some abilities, I think, to really help someone understand, as we contribute and save, here's some of the possibilities, and just know here are some of the different risks. And walking through those frameworks enables you to maybe take a step up in risk that's really going to help the long-term viability of your financial plan.
Totally agree.
What other examples do you have for the accumulation phase?
So I think there's, again, kind of going back to the income statements, we have income, expenses, assets, and liabilities. So when we think through kind of how a dollar travels through those financial statements, it will come in as income. Obviously, whatever we're going to spend, we spend. And then whatever's left over, let's say we spend 80 cents of that dollar, 20 cents of it is left over. It's now going to go over to the balance sheet side of things, or the net worth side of things. And it can do one of two things there. It can be added to assets, or it can be used to pay down debt. And so I think that's something that's really important, and probably an example that I would just talk about, because we get this question a lot, is, hey, I have this extra income. What should I do with it? Should I pay down? Should I accelerate my mortgage payments? Should I pay off my car payments? Should I pay off my student debt? or should I invest it? And so this one's always an interesting conversation. I would say I put this in the strategy camp of what's the right thing to do here. If you are just moving that over to your net worth statement and putting it in cash and earning 2, 3, 4% on it, there's probably an argument to be made, is that the right thing to do with your money? So there's a few things when you're in the accumulation phase. First is, we do believe everyone needs to have some level of an emergency fund, cash reserves. Things happen, whether it be if you're buying a house, anybody that's a homeowner knows that there's expenses that come up with a house. People can lose jobs. There's all sorts of things that happen there. You can Google this and there's all sorts of rules of thumb, but I would say typically 6 months of cash, 6 months of expenses in cash is probably a decent rule of thumb there. I've found that clients have vastly different levels of comfort with cash. There's some clients that live almost paycheck to paycheck and they're totally comfortable. And I have other clients that have $2 million in the bank and they say, if it went down to $1.5 million, they'd be very nervous. They wouldn't be able to sleep at night. There's probably, again, extremes are bad in this one. There's kind of an optimal way to do this, but a general rule of thumb, you want to make sure that when assets move over to the balance sheet, make sure first that your cash reserves are filled. Once that happens, then you start thinking about, well, where do I get better optimal returns with this extra dollar that I'm saving? And, the question that we get from so many people is, should I pay off my debt or not? And that one, I would say, is a really good question from an accumulation standpoint. There's a financial decision that's very simple to calculate. What am I earning on my investments that I can assume? What am I paying on my interest costs on my debt? What are the tax ramifications of both? And then you can make a pretty quick decision to say which kind of is a break-even point that I need to earn on this money to make it make more sense to invest it versus pay off the debt. We can do those almost within 2 minutes and help a client think through that. There's another element, which is, I guess I'd call it emotional or behavioral, that is harder to quantify for people. And I'll go back to my client who went through the depression. And I have other clients like this too that I've talked to over the years that have gone through things early on and they are just so adverse to debt. And so this idea that having debt creates fear, concern, anxiety. I don't know if I'm going to be okay. Have this thing overhanging. I feel like I got to pay it all the time. I don't really know. I could be evicted from my house. There's all sorts of these fears that are out there. So if it's that level of fear that people have with debt, they have to start thinking about, is this really, am I getting the utility, to your point, of the savings that I'm going to get versus kind of this removing the fear that I have around debt. So I try to gauge that, and I think we all try to gauge that, is what's their level of comfort with debt. If someone is just, hey, I can sleep better if I don't have debt, it might make sense for them to do that, even though it's not the optimal way to do it. Even though we might say, there's a much higher probability you're going to have more wealth if you invest this, it still might not be the right thing to do. It's a little bit, it's not a specific example. I would say that happens on a monthly basis here, probably more often across all of our advisors. And it's a very common conversation. It's not just a dollar and cents conversation.
Yeah, and it changes over time, right? Like sometimes in order to be ready to retire, it makes you feel safer to just completely own your house and take that next leap, right? So it's one of these things that you have to revisit over time. The other big kind of component of what goes into a financial plan, and it's really a tactical year to year, and kind of is very personalized, is the tax planning aspect of what we do and why we're the ones stepping in, because it's just a tough thing to do. But tax rate arbitrage is something that is one of the real tools that we have, which is to say, hey, what's your marginal tax rate? How can we move things around to adjust that? And then not only today, what's your marginal tax rate, but what do we expect it to be in the future? So we can think about, when do we want to, quote, recognize income? When do we want to defer a tax into the future? So that's also one of the big areas that we're providing value, is trying to think about, hey, at any given year, what's your tax situation? Before we run out of time, what are some strategies that we can actually put into place to accomplish your goals just in the most tax efficient way possible.
I started the firm, this was 20 years ago. I had just a very small core group of clients, and I went to them because I was curious, and I just asked each one of them, what's one area of your life you feel like you're not getting a whole lot of great advice in? And it was almost unanimous that it was taxes, that people said, I like my accountant, but it's really more at the end of the year, the beginning of the upcoming year, like this time, I start getting all my tax forms from my job and from my brokerage statement. And I give them to my accountant, and they do a great job. They prepare my returns. They tell me how much I'm going to owe, how much I might get back in a refund. And then if I have to pay any estimated taxes, they'll tell me what I have to do for the upcoming year. But I don't feel like there's a whole lot of active approach to figure out ways to reduce my overall tax liability. And this is not a knock on accountants. My dad was a CPA. He had a firm for, 40 years, 50 years. But I think the mindset of an accountant tends to be backward looking. It has to be, because they are taking data and putting it into reconciling it in such a way that it all reconciles on a tax return. And so we just take a little bit different approach. We are more forward looking to say, so to your point, at the end of the year, we are doing projections to try to figure out, what are you going to owe come next April? And is there anything we can do this year tactically to reduce that overall burden? And not only that, what is your overall tax liability going to look like over maybe the next 5 years? And because of, like you said, there could be situations if we're talking about people in the accumulation phase, there could be situations where people lose a job. People just have lower, maybe they're in a position where they have lots of variable income. And so we know that maybe this year they're in a much lower bracket than they're going to be in the following year. Maybe they're exercising stock options. There could be a lot of different things. So they're in a high bracket. So what can we do to plan around that when you're in a low bracket? And there's all sorts of things that we can do there. So we're really looking at that piece of the income statement. One of them is, one area where your money can go is taxes. And how do we minimize that for clients? These are the tactics that we're using each and every year.
Yep. Yeah. And you kind of I think when I visualize taxes, I think taxes are related to salary, right? So then I'm thinking, hey, in the accumulation phase, this is where I want to be really, really focused on. But turns out you actually want to be focused on both phases, right? Accumulation and withdrawal. And maybe this is a good spot to jump into financial planning in the withdrawal phase. But there's so many actual opportunities that open up once the salary doesn't even have to stop, just slows down a little bit, because a lot of people are coasting into a change of life. But how do we think about, hey, now that salary's decreased, it actually unlocks so many more tools for us to really think about how to help somebody maximize their after-tax investments.
Yeah, the withdrawal phase is really interesting. There's a lot of changes that happen for a client. So the first thing that I'll mention, and this is just a little bit more, again, I'll go philosophical a little bit, is just a mindset shift. It is really a challenging thing for most clients to go from 45 years of working to all of a sudden and earning an income and spending based on what they've earned and whatnot, and then just totally stopping that. Or winding that down and going to a point where they have to now live off their assets. And that is a scary proposition. I think it takes some time to get used to. So I think that's an important aspect of us as planners. Good planners hopefully been through this a lot with clients, understands maybe some of the things that are going to be important to a client, security, stability, just understanding how it's going to work. How am I going to get a paycheck in retirement? I used to get this paycheck every week or every 2 weeks. How are we going to recreate that? Those are all really important things. But then you mentioned that there's these other parts of the withdrawal phase that are similar, but there's some real unique situations that happen in retirement. One of the things that we see a lot is obviously people are going from a very high income situation to typically dropping quite a bit. And what's really interesting is that there's these kind of highs and lows. There's kind of a valley that happens when most people retire. I go from working, I'm making really good income. All of a sudden I retire. Let's say I retire at 65 years old. Well, the only income I might have at that point, if I'm not doing consulting or whatnot, is my portfolio dividends and maybe capital gains. I know I don't have to take Social Security yet. I don't have to take any money out of my retirement accounts yet. So I have this valley that I'm in. And there's all sorts of interesting tax planning you can do when you have rate, your income going from really high to really low to eventually maybe going back up to some mid-range at some point, because once you turn into your mid-70s, you're going to have minimum distributions from retirement accounts, you're going to have Social Security. And so anyways, that's part of the withdrawal phase. Again, this is the tactics that are happening year after year. Is we're trying to minimize taxes over your lifetime. And so if you're in a low bracket, let's maybe accelerate some income into those years and pay taxes at very, very low rates so that we don't have to pay taxes in the future at very high rates.
Yeah. And we talk all about taxes, but taxes are just one of the costs, right? So we're trying to minimize the cost, but we're still trying to maximize the return after costs, right? And I think that's something that sometimes also becomes a little trip up is, hey, we're trying to minimize taxes. All of the focus is, let me minimize taxes as much as possible. We want to do that, but not at the expense of a future dollar of gain. One of the other things you mentioned was one of the most important things is kind of replicating that paycheck and retirement income. And income, maybe is just, we'll classify it as a dollar you can spend, right? So what are some of the different ways that you can adjust portfolios to change how that dollar you can spend comes into play? And that's something that's super, super critical in the withdrawal phase.
Yeah. I wrote about this a few years back. I said that the riskiest day in your life is the day that you retire. And the reason why, at least from a portfolio standpoint, because when you think about that day, you have to have your money last for the longest period possible. Every day you live thereafter, the period shortens, basically. So what does that mean from like recreating a paycheck and how you design a portfolio or whatnot? You want to make sure when you're retired that you're hedging out to some degree the risk of a really bad market in the very beginning of retirement. There's a sequence of returns risk that you have to be mindful of. And that's really important in retirement. In the accumulation phase, doesn't matter as much because you're just buying into that. There's some level of sequence of returns that you would prefer to have the highest returns of your life to be at the very end of your working years, because that's when you have the most capital invested, versus having high returns when you don't have any capital investor, you're just starting out. But in the retirement scenario, if we have a really bad market and extended for a long period of time in the very beginning, remember, we have a long period that we need our money to last. We have this big shock to the system immediately. We're still taking money out because we need to live, but we need our money to last. Conversely, if I'm 92 years old and I have a good sized portfolio and the market drops, it's probably okay. I don't have as long of a life expectancy at that point. I'm probably going to be able to weather that storm. So, well, how do you design portfolios? Well, first off, you have to pick a good withdrawal rate. That's important. So how much am I pulling out of my portfolio? We could probably have a whole podcast on that. There's all sorts of different strategies around that. I probably won't get into that, but I would just say you have to pick a sustainable withdrawal rate. And once you pick that, then you need to make sure that your portfolio is positioned in such a way that can weather like a really bad market outcome over the first few years. So we believe that you want to have some level of protection in the portfolio with things like fixed income that aren't going to really, especially like shorter term fixed income that's not going to be dependent on the market to go up or down or whatnot. When you think about that, one of the things we measure when we're putting portfolios together for people that are retired is how many years of expenses do we have sitting in bonds? So when a client comes to us and we look and say, if we were to take the first 10 years of your retirement and we were to say, how much money would we need to have in bonds today to be able to essentially fund that first 10 years? Let's just say that's $1 million. Well, we probably are going to look to say, well, how much do we actually have in the portfolio? Do we have $1 million? And for a lot of clients, if they want to be less risky, they want to be more certain, then they might say, I don't want 10 years. I want 15 or I want 20 years of certainty around spending. And so we may have the fixed income look like that. Others would say, no, there's a cost to that. Again, trade-offs. The trade-off is you're going to have less in equities, less in growth assets, probably going to have less ending wealth, but more certainty around your spending. The other side of it would be the client that says, no, I want to have more opportunities maybe to spend more in the future, or I want to have more legacy wealth, or I may want to buy a second home down the road. I want to have the potential to do that. So I'm willing to maybe have a little bit shorter certainty, but I'm going to have more upside. It's not a guarantee, but certainly more upside to my spending in the future or to my legacy wealth that I'm going to leave. So those are really important decisions. The actual tactical of most clients, what they like to see is once a month on the first of the month, I get a paycheck, and it's some level of dollars that we've kind of measured compared to their financial plan spending, and we want to marry those two up. And so that's coming out of the portfolio. And again, that's the tactical of where do we pull it from? What's the most tax optimal? Which accounts? Again, that's very circumstantial to the client, but that's kind of how it works.
Yeah, I just love that this is the riskiest day of your life, and you're trying to hedge against two risks, right? Which is what happens in the short term. There's this terrible market drawdown, but then at the same time, like we don't know what's going to happen 30 years down the road. And as you look at life expectancy changes, especially for the wealthiest of Americans, your withdrawal phase is roughly as long as your accumulation phase, right? So it's kind of there's this juxtaposition. You have short-term risk and long-term risk, and bonds help you reduce that short-term risk, but they increase some of your long-term risk. Vice versa, the more long-term risk you're trying to hedge out, you're going to have more short-term risk. And getting that balance right is incredibly challenging. A lot of times there's also this concept of, we were talking about earlier, income. I want income, and the definition that is driven is income is things that are just generated where I don't do anything from the portfolio. So dividends and interest, capital gain distributions, if you're still in legacy mutual funds that haven't evolved yet, those will kind of be factored in. But the way we think about income is now sometimes it's actually more tax favorable to think about a total return approach, where instead of a dividend is just the company giving you cash from their bank account to your bank account, that reduces the value of that company because there's less cash there, right? So what if we just sell some of that company and put it in your bank account? There's different ways where you could do things like that aren't traditionally viewed as income, but we view it as income because we can actually control some of the tax levers a little bit more precisely through some of these different mechanisms.
Yep, totally. I think there's one other component on the withdrawal phase that I wanted to touch on that I think is worthwhile, which is spending in retirement. When we're in our working years, you can see spending it's pretty variable depending on, are my kids at home? Once they go to college, all of a sudden my expenses go up because I got to pay college tuition. Then hopefully you're empty nesters, they're off the payroll, your expenses go down a bit, but maybe you start to travel. So there's this volatility to overall spending. But there's been some research that's been done in this space. David Blanchett from Morningstar is probably the one that comes to mind, that looked at aggregate retiree spending. So what really happens when you retire? Is it fair to say that you're going to spend the same at 65 that you are at 85? And I think anybody that has aging parents or have been through kind of the life cycle of spending, the answer to that's probably no. We tend to be more active at 65 than we are at 85. And so what his research found is that actually real spending rates, spending after inflation, goes down all through retirement until maybe the very end. There might be some healthcare costs at the very end that spike back up, but it's something to consider when you're doing your projections. Again, we have to make assumptions into the future, and we would rather be conservative in our assumptions. To be conservative in spending means we're going to assume that you're probably going to spend a little bit more every year. But I think it's something to really factor in and think about in your financial plan is, what is my trajectory of spending going to look like? Am I still going to own the second house at 87 years old? Maybe not. Maybe when we start thinking about that, it's like, well, yeah, I'm not going to want to maintain two households. I'll probably downsize at that point. What's that going to do to our overall spending? Well, now all of a sudden we don't have real estate property taxes, to your point, a cable bill, utility bills, all those different things. I think it's really important to not just say, well, whatever I was spending before retirement is what I'll spend after, and that'll just stay in perpetuity. That's probably not the case. There's going to be some leveling off of spending, or maybe even a reduction. And just anecdotally, what we're seeing with clients is somebody that comes to us and says, we would like $10,000 a month, for example, to kind of handle our spending in retirement. And we set that up. They don't come back to us typically. I've almost never seen this happen a year later and say, I need my inflation adjustment because costs are going up. What tends to happen is 5 years later, we're checking with them regularly. And, we may say 5 years later, hey, we haven't really changed your spending out of the portfolio. Are you doing okay? Like, yeah, we're doing okay. Well, is it because what's really happening is they actually are spending less on a real basis because costs of goods are going up, but they're spending the same. So they're buying a little bit less. That's kind of what we've seen anecdotally. It doesn't happen with every client, but it kind of validates the research that we're seeing out there.
Yeah, and it validates kind of working with somebody through the life cycle because you want to be able to help guide them. The way I think about it, when my knees are still working, that's when I kind of want to use them, right? So now, hey, can I make sure I'm taking the vacations I want, building the memories I want with my family when I can? And I want to have the confidence in my plan where I don't have to worry about that down. You have a saying about spending in retirement. Do you remember what that saying is off the top of your head?
Yeah, I didn't come up with this. This is I can't remember where I read this, but I think it's exactly the aspect of what I was just talking about. So there's kind of 3 phases to retirement spending. You have the go-go years, the slow-go years, and then the no-go years. So, the go-go is I'm retired, I'm ready, I'm traveling, I'm going to go see the grandkids all the time, we're going to be active. Then the slow-go is maybe somebody has, some sort of surgery or something or whatever that forces them to maybe just travel a little bit less, go out to dinners a little bit less, or just activity starts to slow a little bit. So spending tends to kind of match that and slows down. And then no-go is it really starts to slow significantly, and that's kind of towards the end of retirement. So I think as planners, we need to think about how are we modeling this for clients, because again, the sensitivity is very high in these models. If you say, I'm going to assume that they don't increase their spending in retirement versus they increase at the rate of inflation, you can have drastically different incomes that are different probabilities, which means drastically different amounts that you need to be able to retire successfully. And that means maybe when you can retire. So I would encourage people, if they're working with a planner, be conservative in don't assume that, I'm just going to spend nothing when I'm 85, or I'm going to cut my spending in half. I think you want to be careful. You don't want to get to 85 being great health. We're talking averages here. So There's people above and there's people below. So we want to make sure that we're not saying, similar to trying to pick when your life expectancy is, you want to be conservative. You don't want to get to the average life expectancy and then realize, well, that's all as far as my financial plan went, realizing that more than half the people are going to live past that age. So just a word of caution, I guess, more than anything, is make sure you're conservative in your assumptions for retirement spending, life expectancy, things like that.
Yeah, the thing about assumptions is oftentimes they start building off of each other, and this is where you want to be really careful. It's, hey, I assume this for my investment return, and then now it's, okay, since I assume this much investment, now I'm going to assume this, and now I'm going to assume this. And each one of those assumptions have these range of outcomes, and when you stack them all together, that's where you just have to be really, really careful, as you allude to make sure that at the end of the day, you're protecting kind of the minimum best case scenario for you.
The last thing I just wanted to mention on it, because I think it's a really good point on assumptions. When you're young, in your 20s, we talked about accumulation phase, the assumptions are fairly important. But if we're thinking about retirement, for example, we have no idea. You don't know at 25 what you're going to be spending, where you're going to be living, all these things. Make some good, to your point, you don't need a complex plan. You could probably do it on a 1-page piece of paper, make some basic assumptions, get the strategic part right, and you're going to be in good shape. Every year you get closer to retirement, the assumptions become more clear. It becomes more certain, because if I'm 30 years away from retirement, I have no idea what I'm going to spend. I don't even know where I'm going to be. If I'm 1 year away from retirement, I have a pretty good sense of what my life's going to look like next year. So again, that's why it's so important to be dynamic, keep coming back to it. Because the assumptions become certainty over time and they turn into real results. And so again, even in retirement, there's more certainty around what life's going to look like, how much you're going to need. And we can say with more certainty how how much, what the likelihood is, the probability of success as we get closer.
Yeah, Pat, I can't think of a better kind of group of closing comments than those. I would add that, I would just really think about the difference between dollars and happiness. I think that's the most crucial trade-off, especially for people that are too analytical like me and not as much fun as we should be. We should be thinking more, hey, how do I turn this into something that I can enjoy? Do I want to enjoy that moment more now, or do I want to enjoy that moment more into the future? How can I think about maximizing my enjoyment? And then all this other stuff, tax location, asset allocation, withdrawal strategies. How do I think about tax planning, towards the very end of the year, and I got to get, that's the type of stuff you want to outsource. Why? Because it's not happiness related, unless you're geeks like us, in which case you do this for a living and you love it and you wouldn't change it for the world. So with that, Pat, I'll let you go before I make any more bad jokes.
Good conversation. Thank you.
All right.